Hi, everyone, and welcome to AB Conversations, where we will help you CFP your way out of it. A podcast where you get into the minds of a couple certified financial planners on how we think and feel about everyday financial planning questions and what should really matter most to you. A healthier financial life starts now. Hey, Adam, thanks for jumping on. We've got an action-packed mid-year kind of investment review here. So I know there's a lot of content. Welcome aboard. Thanks for being willing to be in the driver's seat today.
Ooh, all right.
I will certainly co-pilot with you.
Sounds great.
But let's do it. We're halfway through 2023 after a very difficult 2022. So let's maybe look back on the first half. Where are we at? What are you seeing? What are you thinking?
Yeah, I think if we had to poll all of the people that we work with, ourselves included, how would the first half of 2023 have gone? If we did that poll January 1st, I don't know that any of us would have predicted, the NASDAQ, like the tech-oriented sector of the market, would be up almost 40% in the first 6 months of the year, the S&P being up 16%. It's been an interesting start to the year for sure, in a good way. There's been a lot of positive developments, but there's still some risks on the horizon, or maybe even closer than that we're keeping an eye on, and we'll kind of walk through some of those things that we're focusing on.
Yeah, and you often say it, and I like the visual of this. The market is, of course, very capable of climbing this wall of worry. So I think for I don't want to say passive investors, but those that kind of are tuned into the news, like to kind of know what's going on. When you hear inflation, Fed rate hikes, bank failures, we know the politics of the debt ceiling debate not too long ago, geopolitics, all of that stuff can give us a lot of anxiety. And we would think that when we hear these not so great things in the news, that the market can't be doing well because of that, right? So it's been an interesting 6 months for sure.
Yeah, there's a saying for, and I think it's more particular for like day traders, people that are constantly moving in and out of the market, that the market can stay irrational longer than you can stay solvent.
Yeah.
And a lot of that feels true. Like you just listed all of the potential headwinds, and yet here we are with a very strong start to the year. And it's why we believe in diversification, and why we believe in just very philosophically fundamental building blocks of investments. And you let time be on your side.
Yeah.
And this is just another, I think, example of why you do that, and you don't make big bets one way or the other, because you can get caught when the market's moving a different direction than anyone probably believed it could go.
Yeah, if you trust your gut, you'll probably be out of the market more than you're in it, and that's not good. And another indication of kind of how I would say the market's very different than the way that I've even personally been feeling. We follow the volatility index, which is just one measure of how the market is perceiving future risk and volatility in the market. And if that's historically around 18, we're lower than 14 right now. That's as low as it's been, since pre-pandemic. So let's pivot. Let's go into some of the highlights from the year now that we've kind of level set on your emotions don't equal the market. What did we see from the first half of the year?
So we'll start with bonds, because I think that was one of the biggest surprises for 2022, right? We've talked about this ad nauseum, but people expect, or they've come to realize, that the stock market's going to be volatile in different periods of time. We're somewhat, I don't want to say immune to that, but we're used to seeing those larger movements. 2022 was a bad year for bonds, the worst in like 40 or 50 years, or maybe ever. So we haven't seen this rapid response from bonds yet this year, but that does somewhat make sense, because we're still fighting the very similar circumstances from last year. It's inflation, it's Federal Reserve rate increases, and at what point is the Fed going to get to the other side of being able to not continue to raise rates, maybe start to cut rates at some point in the future? When inflation comes down, that will bode well for bonds. But all of that being said, depending on the area of the bond market, they're up anywhere from 2 to 4% here in the first 6 months, which, if that continues, you annualize that out, are we between 4, 6, 7%? that would be very normal kind of bond expectations for us in this kind of new higher interest rate environment. So that's been a good development to start the year. And as we talked about, stocks are kind of off to the races. But that being said, it's in a very select group of the stock market that's really kind of leading the charge.
Yeah, tech and communication specifically, and you mentioned it right at the beginning here. The Nasdaq, there are different indices that you can follow. The Nasdaq being one that really got beat up last year for same reasons as bonds. A lot of rate increases were not perceived to be good for those growth-oriented companies. So yeah, we haven't seen. I don't want to use the word market breadth because that's maybe harder to explain. But if there are 500 companies in the S&P 500, we haven't seen a lot of them positive, even though the index is pretty high, simply because those biggest companies that you would know by name, they make up disproportionately a larger percentage of that index. So it looks great. The S&P 500, like you said, is up 16%, but how many companies are actually participating in that growth? It's not as many as we would like to see.
Yeah. So the good news there is it's starting to trend in the right direction, that some of the companies that hadn't been doing so well to start the year are starting to kind of catch up to these bigger growth oriented names. And a good way that we compare that is you just look at the broad S&P 500 and what is that doing? And then you compare it to what they have is an equal weight index. So we'll go back. Oh, is this like a 200 level course on the indices? So the S&P 500 is a market cap weighted index, meaning take Apple, for example. You've probably seen the headlines. It's now worth $3 trillion in market cap. And essentially what that means is all of the shares of Apple stock outstanding multiplied by the price of the stock today, and that gives you the total market cap of the company. It's worth $3 trillion. Well, the S&P 500 index is market cap weighted. So the bigger the company, the bigger percentage of the overall index it becomes. So right now, I don't know what the exact statistic is, but basically the 5 largest companies in the S&P 500 make up more than a quarter, more than 25% of the index. So it's one of those situations where if Apple is doing very well and some of these bigger companies are doing well, that can kind of pull the entire index with it, but that doesn't necessarily give you a full picture of all the 500 companies within the index. Sometimes if Apple is up huge, that can kind of drag everybody up, even though, some of those other stocks may not be doing so hot. So to be able to compare the S&P being up 16, 17% or so year to date, the equal weight index is up about 6 to 7, closer to 7 at this point. Earlier in the year, the S&P was positive and that equal weight was negative. So that's why I'm saying we're kind of trending in the right direction, that kind of things are catching up. But it's still, I don't want to necessarily say it's a cause for concern, but when you have returns concentrated in a select group of companies, that could quickly turn the other direction depending on any outside influence or an event that happens in the markets or in the world.
Yes, it goes back to that concept of kind of diversification, and you don't want your whole portfolio to go as Apple goes. Right. You want, if we are to be moving into some sort of bull market now after having a very difficult 2022, hitting that bear market, we would love to see more participation in that. So sticking with diversification, you kind of mentioned what's going on in bonds. We mentioned kind of what's going on in stocks. What about international, year to date?
Yeah, it's been interesting for international, and it's different pockets doing better than others. But broadly, international is doing quite well to start the year. And a lot of that just has to do with, part of it is central banks. So like we have the Fed in the US, but a lot of other countries, or even in Europe, they have the ECB that basically controls monetary policy across Europe and not just country specific. But essentially, they're in a very similar situation, interest rate hikes to try to combat inflation. And there's a case to be made that depending on the different economies across the world, some places may be slightly ahead of schedule than we are in the US, meaning they might be closer to being able to not continue to raise rates. it's still very difficult, but the positive sign is international investments are starting to actually give us some return that we haven't really seen for the last, decade or so when compared to the US. It's been, if you hadn't owned international for the last 10 years and you purely owned US, you did okay. But at a certain point, we're starting to see that shift a little bit. So we'll see how that continues to play out. But I think we're at least heading in the right direction. The one thing to note is, I think this is going back to the first quarter of this year, maybe. Germany, and I guess the parts of Europe in particular, actually had a technical recession where they had two straight quarters of negative GDP growth. So that's another argument for why they may be able to come out of this quicker, maybe not necessarily quicker, but before we do,
right?
Because they've already kind of seen some of that negative impact economically in their GDP numbers, where we're still just kind of chugging along in that we're still positive, but we're in that 0 to 2% range of GDP growth right now.
So then let's stay there. If we were to kind of pivot from where have we come in these last 6 months, first part of the year, to now, maybe what are the things that we're paying attention to or would want to speak to for these next 6 months? I'd kind of throw it back to you with the softball that I'll throw here. There's still a lot of focus on the Fed and inflation. And really, are we going to be able to kind of, I don't want to say thread the needle, because that makes it sound like it's almost impossible, but maintain this balance between trying to make sure that inflation's not going to be runaway, make sure the Fed doesn't have to raise too much higher where it may add additional bank stress, and we can talk to that, because all of that may inform, really the trajectory of stocks. What say you? What are we kind of looking at as risks or things to really pay attention to for these next 6 months?
Yeah, I think the Federal Reserve is in a really tough spot right now. The June meeting, they didn't call it a pause. I don't know that they gave it a name. A lot of people are calling it a skip, because it was a very weird kind of press conference, the meeting minutes, it didn't quite compute. It was a unanimous decision to not raise rates, but then part of their predictions for the rest of the year, or their projections, are showing probably another 0.5% of rate hikes. So, the logical side of my brain saying, well, if you think you need more, then why wait, right? You're just kicking that can down the road. So you have that kind of at play. Part of that may have just been to try to buy themselves time to see more data, to see what inflation numbers will look like over the next month or two, because the key point in that data, the inflation that they're looking at, the peak was last June in inflation, whatever we ended up at, 9-point-something%, year-over-year inflation. Well, those huge inflation numbers from last year will now start to roll off. So just by that, from a data set, those higher inflation numbers will start to be replaced with more moderate inflation numbers, and that will appear that inflation is slowing without any more kind of influence from the Federal Reserve. So it'll be interesting to see how the next few meetings shake out. I think you're more well versed in kind of looking at the Fed Watch tool that's showing what is the market expecting from the Federal Reserve, and I'm pretty sure July is still looking like they will raise rates another quarter point. But I'll kind of tie that back to the banking stress that we've seen. I think a lot of that has been subdued, and there was a report last week or the week before that the major banks, they kind of went through that stress test and they all kind of came out with flying colors, and the market has responded positively to that. But we don't know if we're out of the woods yet from the banking stress for these more regional banks that are just overexposed to technology and had other risk issues underlying. The worst case scenario, I think, for the Fed and for the markets is if we do continue to see a domino effect of more banking issues and more stress, because that's going to put the Fed in a spot where they may be reluctant to continue to raise rates to try to take some of the pressure off of banks. But even then if they do, Say that again.
Even if they should from their data.
Right. They may just be choosing the lesser of two evils in that scenario. And if we see any sort of uptick in inflation in that same scenario, where now the Fed has to take their foot off the gas to help banks and the banking system at large, and inflation ticks back up, they're going to be in a very tough spot. Damned if they do, damned if they don't situation, where the market would react very negatively to that scenario. That's not our base case. We don't expect that to happen, but that is a risk that is out there, that if there is more stress in the banking system, and depending what happens with inflation and what the Federal Reserve does, that can certainly add a heck of a lot of volatility through the end of the year, if any of those things come to materialize.
So if that's the big risk, and again, maybe that's not the base case per your comment, is there good news in all of that? Is there opportunity in that? Or, is there not enough of that good news or opportunity to be worth talking about it on a podcast here that we can look back on 6 months from now and say, oh, well, was that really good news or not?
I'm not sure. So just thinking from a performance perspective, right? We talked about how 2022 was such a bad year for pretty much all risk assets, bonds included. Even if I'll put a pin in that side of things and just think about our economy in general. And we said earlier, we're kind of still chugging along in that positive growth, range right now. If we did see further slowdown in growth, and maybe we do see something negative, maybe it's later this year, maybe we're kicking that can into 2024 at this point. All the data we've been talking about recession for how long now?
Since last March, yeah.
So it just keeps getting prolonged and prolonged and prolonged. There's a chance that if we do see a recession, or we just see that continued slowdown in growth, the market will just take time to digest that. But from that standpoint, we wouldn't expect any quick move to the downside, because it's been such a long time coming that a lot of that gets baked in, right, priced in before we would actually see kind of that negative data show up, because it's always backwards looking.
Right. Yeah, and I'm glad you said that, because maybe we're leaning to the recession word sounds so negative, and maybe that's a risk right now. But I think the point you're making, the good news is the market's meant to be very forward looking, right? A recession is an economic term. And if you need to go back no further than the pandemic, the market was recovering a lot sooner than economically we were recovering. We were still in shutdowns. So we could be in that spot right now where economic data may be slowing down, but the market being very forward looking, we're starting to see that push higher in anticipation that they call it a soft landing, that we're going to be able to kind of get ourselves in a spot where the Fed raises rates enough for inflation to kind of be back at where they want it to be, without really pushing the economy into a deeper, darker spot.
Yeah, and there is another saying: it's "don't fight the Fed" when it comes to investing, right? Even though they only have so many tools at their disposal, it clearly still does influence the market, to the point that I'm not exactly sure how long ago it was, but there, with that Fed Watch tool, the predictions on where the kind of the market is expecting the policy to be on interest rates, that prediction tool was projecting interest rate cuts at the end of 2023. Now, you and I were having conversations like, I don't see how we would get to those cuts without some sort of like economic need, right? A bigger recession that would cause the Fed to quickly change stance. And we still think that's the case. And by the way, those projections now on the Federal Reserve cutting interest rates are pretty much gone for 2023. And again, those now are kicked into 2024. But what the point I would want to make, and it's not just the Fed, it's central banks around the world, that if at some point, even if there is a mild recession, or we just see growth kind of eking along, like inching along, we don't expect the Federal Reserve to quickly come to the rescue in that scenario and quickly cut rates. And the reason for that being because they're the ones trying to cause that slower growth to bring inflation down. So I think that's Yeah, that's a bit of a shift from what I think investors have been used to. When you see growth coming down or you see a recession, it's very common to see the Federal Reserve now cut rates to try to spur growth. But this is not, I don't want to say it's not a normal environment, but it's tricky for the Fed and for central banks around the world because they don't want to come to the rescue too quickly for something that essentially they're causing for good reason to bring inflation down. So I think that again just kind of pushes out our expectations for kind of a fast rebound. Again, that's not our base case, that we're just going to continue on the trajectory that we've seen here to start the year. It would not be surprising at this point to feel some sort of pause or some sort of consolidation or some sort of pullback, from now to the end of the year. And maybe it's not prolonged, but just, I think the market needs to take a bit of a breather after the first 6 months and kind of reassess where are we actually at and where are we headed. But I guess let me pause there and take a breath. Is there anything you want to add to that?
From the client perspective, I think the question is always going to be, is there something looming that I should be seriously concerned about, or that would inform you and I and the team here to do something different with portfolios? And I'm always worried that word recession sounds like such a horrible thing, when if we think about the parts of the economy, when we think about the labor market right now, all we want to say is that if that word recession comes into play based on data, it doesn't have to mean that we need to do anything vastly different or that we should be uber concerned about that. So that's kind of the lighter side, the 100 level response to a lot of what you're giving us here in great commentary.
Well, so to that point, the cyclical parts of the market, the things that go up and down over time and aren't just kind of your steady defensive sectors, there hasn't been any excesses. There really nothing has been overextended. You go back to 2008 and the great financial crisis, and you had that big bust in the housing market, right? Because it was overinflated, probably well beyond what it should have been in the first place. There's not really any evidence of that in sectors of the market right now. And if there isn't the boom, then it's hard to see the bust, to go along with the absence of that boom. So from that standpoint, right, even if we do go into a recession, we don't expect it to be a huge kind of drawdown in the market. Again, it's all kind of been baked in a little bit to this point. And to I would say back up your point on kind of the strong labor market right now, that's another reason why even if we saw a technical recession, it is still a historically tight labor market. The unemployment rate is still historically low. And I don't know if it's in the notes here, but it was one of the calls I was listening to last week. Even though initial claims for unemployment have been, I guess they've been kind of all over the place, but I think those kind of ticked up, but the ongoing claims for unemployment essentially stayed the same, which the way that data was interpreted, or the way that I heard it was, yes, people are getting laid off, but there's so many other jobs out there that people are able to quickly pivot to another job. So that's a good sign for the economy and the labor market, that if somebody loses their job but could quickly go out and replace that doesn't usually lead to an economic collapse, because ultimately it's the unemployment and people being very hesitant to spend is what usually kind of drags growth down the quickest, because consumer spending is such a huge component of GDP in America.
Yeah, so maybe that's a good way to kind of transition this into then portfolio management. This is a financial planning podcast. It always will be. So let's kind of wrap up all this commentary with asset allocation. And the point that you just made is one of those things to pay attention to. As you think about yourself, your consumption, how you're spending, right? If you're kind of seeing it in yourself, you're not doing anything vastly different, then don't be fearful of your portfolio and that you need to tighten the reins either. We'd say stay the course, live your life. If we hear the recession word or the market comes back a little bit, we're not planning to do anything vastly different. Maybe we can talk about the rebalance word, Maybe we can talk about, where you get opportunistic, right? If the market does pull back, isn't there reason to actually be a buyer, not a seller?
Sure.
These are all themes that we talk about a lot. But what would you highlight as kind of our take on asset allocation looking into these next 2 quarters through the end of the year?
Yeah, I think given where we're at in the market, and it's not just stocks again, it's bonds, and with interest rates kind of affecting bonds still, our approach is to be fairly neutral. Again, we're not making big bets in any one area. And the reason for that being, number one, we just fundamentally believe in diversification, but also right now, it's really hard to know where things are going to go. So by taking a neutral kind of standpoint, I liken it to the center fielder, right? In baseball, you got to just you got to have a neutral stance so that wherever the ball is hit, you can react. You're not leaning one way or the other. And that's kind of how we feel right now with the investments, that if we continue to see volatility at some point, I shouldn't say that. If we see volatility pick up again later this year, there may be opportunities either to rebalance again, to go back to your targets, depending on which area the markets are doing well and when, or as you said, looking for those opportunities. If we do see some sort of pullback or a shock to the market from who knows what influence, that may be the opportunity to now reassess how you're allocated and look to take advantage of what may be kind of that next bull market. I guess, even though technically the S&P is in a new bull market because it came off the 20% of the lows, doesn't matter. I think kind of pivoting to now looking for opportunities moving forward, albeit it may be a little early to make those moves, but now's the time to start thinking about how would we want to position if we do see growth continue to slow down, if we see a recession later this year. It still will move segments of the market, and that may be the opportunity to make some transitions. But again, as we've said before, when it comes to our side of portfolio management and investment management, it's more like moving the dimmer switches than we are, flipping the light on and off. But yeah, it's pivoting to now looking for maybe some more opportunities moving forward.
Yeah, and without a crystal ball, I guess my takeaway from that is we don't know where things are going. It may get volatile again, right? There are risks on the table, but pat yourself on the back. You've hung in there. It was a very tough year last year. Even if we do see volatility, we don't anticipate hitting those levels last year, those lows. So in that case, we are looking forward. We're not looking in the rearview mirror. Hang in there, and long term, we certainly still feel good about where these markets are headed, however long it takes to get there and whether we hit that recession or not.
Yeah. So one maybe not the last, but another positive, money market mutual funds right now, we're basically sitting on records amount of cash in the mutual fund market. So if we saw any volatility or a big move kind of to the downside in the stock market, there is a massive amount of cash sitting idle right now. And maybe it's not as idle as it once was, right? Cash is finally paying something, and that's part of the reason these money market funds have grown as big as they have right now, because interest rates have climbed. But there's something to be said for when there's so much when there's so much cash just kind of sitting there waiting to be deployed. Market pullbacks in that scenario typically don't last very long, because that cash gets put to work and that pretty much props up the market, because again, it's very forward looking. So even if the environment, in the moment doesn't feel good or look good, investors typically are looking beyond that and looking for that longer term growth. So from that standpoint, cash sitting on the sidelines, by the way, you're earning something sitting on some cash right now, is a good situation to be in, that if we did see volatility or we did see a pullback, there's cash to be put to work kind of across the board. And that kind of limits the downside to stock markets, assuming it's not, a World War III or, nukes are flying. It's in any normal slowdown of growth and recessionary environment.
I like it. I hope this was helpful. There was a lot to digest. And while there was a lot talked about, I hope that the benefit of the podcast is to kind of just go back to the whole purpose of why you put an asset allocation together and philosophically how you think about investments. There's going to be good, there's going to be bad. There's going to be a lot of times where the market doesn't feel like it's making sense to you or me, and that's okay. If you're able to kind of understand the purpose, understand diversification, understand that over time these things should work out, and if you can stay the course when headlines aren't kind. But
yeah,
I will continue to be an optimist for the second half of the year. How about you?
Sure.
You can balance me out.
No, I'm not saying I'm not pessimistic on the second half. I just think at this point, people are
optimistic.
Yes, I think people are seeing the returns from the first half of the year and thinking, this is great. I hope it continues. I want to recoup everything that I lost in 2022. I don't think that's going to happen. I don't think we're going to just hit all-time highs again by the end of the year, but we'll take what we can get when we can get it, right? The market has been good to us these last few months. And even if we did see a pullback, like all the other times before it, we anticipate that being temporary, and we'll be back on the rebound at some point moving forward.
When in doubt, zoom out.
That's right.
All right. Thank you for all the help here.
Yeah, thank you.
Appreciate you leading the charge.
Absolutely.
Till next time.
Bye.
Hey everyone, Adam and I really appreciate you tuning in. Please note that the opinions we voiced in this show are for general information only and are not intended to provide specific recommendations for any individual. To determine which strategies or investments may be most appropriate for you, consult with your attorney, your accountant, and financial advisor or tax advisor prior to making any decisions or investing. Thanks for listening.